Hello, welcome to Born Investor. In today's video, we will be going to learn about the following. First, what is averaging? Second, how does averaging works? And third, when to do averaging. Generally, when price of a stock starts to fall down, we have three options available to us. First is to sell the stock making a loss. Second is to wait until the price rises and ignore the current conditions. Third is to see this as an opportunity and buy more stocks of the company. The third step is what we call averaging. Whenever in the video the word averaging is used, it means the case of averaging down. We will discuss averaging up later in this video. Averaging in stock market is a strategy to buy more shares of a company as its price falls down, which results in a lower overall average buy price. This is usually known as buying the dips. Adding to a position when the price falls can be profitable in a bull market but can increase losses in downtrends. However, we will discuss later when we should do averaging. Now, let us take an example of how averaging works. Suppose we have bought 100 shares of ABC Limited at a price of rupees 500 each. So, our total investment is 500 into 100, that is 50,000 rupees. Now, if the share price of ABC Limited becomes 450 rupees each, so in that case, our investment becomes 45,000 with an unrealized loss of 5,000 rupees as the price of ABC Limited now becomes rupees 450 each. This can be seen as an opportunity to buy more shares of the company at a low price than before. Assume that we bought 50 shares of ABC Limited. So now total number of shares are 150. The average price of these 150 shares will be less than before and it is calculated using a formula. That is, average buying price is equal to P1Q1 plus P2Q2 divided by total number of shares, where P1 is the price at which we bought shares initially, that is rupees 500. Q1 is the quantity, that is 100. Similarly, P2 is the price at which we bought later, that is rupees 450, and Q2 is 50. So the total number of shares are 150. So by this formula, the average price of 150 shares that we have in our portfolio is 500 into 100 plus 450 into 50 divided by 150, that is 483.34. And when price of ABC Limited will become more than 483.34, there will be some unrealized profit. But we cannot do averaging in every company because if the share price tends to fall down, we will be bearing more loss. So let us know when we should do averaging. We should only do averaging considering the following two conditions. First, we should restrict averaging to blue chip companies only. These are the companies which have a reputation to operate profitably in both good and bad times. This is because in blue chip stocks, the risk of corporate bankruptcy is low. They have a strong competitive position, low debt to equity ratio, solid cash flows, and some other criteria which are best suited for averaging. Some of the examples of blue chip companies are Asian Paints, DMart, TCS, etc. Second, before averaging down a position, we should always have a look at the company's fundamentals. The investor should ascertain whether a significant decline in the stock is only a temporary phenomena or a symptom of a deeper problem. These are some of the important steps you should consider before averaging down. Now, from the beginning of the video, the method of averaging that we understood is called the averaging down method because in this we average when the share price goes down. But sometimes share prices tend to move rapidly and the investors gain more confidence on the stock and start buying more. This will, however, increase the averaging buying price and the method is called averaging up.